So last chapter, yay, statement of cash flows. This goes back to that accrual accounting that has been on every exam that you've had. FASB requires you to do accrual accounting. Remember, FASB is the Financial Accounting Standards Board. They do that because they think that has a better picture what's happened this period. If you perform the activity that you're hired to do, it's revenue. Doesn't make any difference when cash is received. Analysts, however, the people who use your financial statements, they kind of like to know cash accounting because you can't pay your bills with income. So you can do all sorts of work and have lots of revenue, but if you haven't collected any cash, the utility company doesn't really care. We need cash. And again, if you watch Shark Tank, Mr. Wonderful always says, I like cash. You need cash for your business to, we'll even put thrive. You can't do without cash, but we want to know if you're doing things as well. What FASB says is we really have to show both. If income is growing but not cash, is that good or bad? So, well, the good thing is providing lots of goods and services. People like what we're doing, but people aren't paying us. We're probably not collecting our accounts receivable. Sometimes we might be kind of selling to people with bad credit. And sometimes it's actually a fraud. If you just make up sales, and that's what WorldCom and some of those other big frauds were, they were just booking sales and there was no cash ever to be collected. Going the other way, if you're collecting lots of cash and there's no income, well, that might be that you're kind of getting deposits, so it's unearned revenue, but not doing anything. Those warranty companies, for example, there was a big warranty company in St. Louis that went out of business because they had lots of people who gave them money. They spent the money and didn't do the job. So that's not a good sign either. We'd like to see a company always growing. So if your cash is going up, but your income's going down, you're kind of collecting your old receivables, but not doing anything new. And over here, it's kind of the opposite. And you're not collecting the cash from the people. So either of those are bad. And the combination is really what tells you what a company's doing. You want to see how the income's going and are you collecting the cash for doing that? That's why both of them together are a good predictor of stock price and future cash flows. What makes our cash flow statement so good, the general rule is the past predicts the future. Not always true, but as long as our product stays good and our marketing stays focused, we should be able to increase the cash flows in the future. Also, obviously, you need cash in order to pay off your liabilities and you pay off your dividends. It also identifies specific differences between the income and cash flows. Things like depreciation are really special because it's an expense but not a cash flow. There are things that affect our income statement, but doesn't affect our cash flows, at least not in this period. But really the biggest reason we like this is we can kind of figure these out just by looking at our balance sheet and our income statement and making a few little minor adjustments like backing out depreciation. But what the owners know that the investor doesn't know is which of those income items and cash flows are operating, investing, and financing. Operating cash flows are what you get from your regular business. And so that's really what the investor wants to know. Is this good? Is it increasing? Are you generating cash from your normal operating procedures? If you're getting all your money from selling off all your buildings, well, that's not really a good idea. if you're getting all your money just from getting lots and lots of bank loans. If it's too much, it's a bad thing. When we see our net income and our change in cash, how much goes in each one of those categories? Yeah. An important thing to know, it's just an alternate view of the accounting process. It's not separate bookkeeping. All we're going to do is make adjustments to the income statement and the balance sheet to show our change in cash. And when I say adjustments, I really just mean moving stuff around. That our assets equals our liabilities plus stockholders' equity. What we want to describe here is our change in cash has to equal our change in liabilities plus our change in stockholders' equity minus the change in all those other assets. And so we're going to basically just take our income statement and balance sheet, rearrange everything so when we're done, our bottom number is change in cash. Format, and is what's kind of important. The statement of cash flows, the first question is it for a time period like the income statement or a specific date? So if we think about our balance sheet is that snapshot. Sometimes they'll call it a stock. That's a snapshot of what do you have on December 31st. And on January 1, you've got a different cash balance. So what do you have on a particular date? The income statement is a flow because that's for a period of time. So we can have an income statement for a month, for 6 months, for a year. And so that's a flow. We have to come up with a beginning date and an ending date. So the question is, what's the cash flow statement? A little guess there. So again, the cash flow statement is a flow, which means you have to come up with a start date and a stop date. Always has to be done once a year. A lot of companies will do it more often than that. 3 parts to the cash flow statement. The operating cash flows tells you cash from your normal operations. Working capital are those items that it takes you to get from starting your company with cash to buying your inventory to having accounts payable. So your working capital are your current assets and your current liabilities. And if we're going to figure out our working capital, you subtract those. So it's the amount that, again, you generate from your accounts receivable, how much you have in accounts payable that you have to pay. So that's the cash flows you generate from operations. Those will all be kind of shown as changes in those current assets. Cash from investments, and this is a little bit different from what you and I think about it. If a company buys a building, that's an investment for the building. So this is changes in your long-term assets. If buildings go up, that means I bought a building. If buildings go down, I sold a building. And I got cash from buying and selling. So the changes in the long-term assets is what we call cash from investing. Financing is the cash you got from changes in long-term liabilities. If I sold some bonds, I got some cash. So that explains where the cash comes from. And something you don't think about is financing, but you also get financing from your equity. Because in finance terms, if I issue stock, I'm issuing stock as a way to finance my company. So we usually think of financing through the bank, but if I issue stock, that's a way to finance my company by selling more shares. That's really all I want you to know here. And so I've got Amazon's financial statements here, but this is what your statement of cash flows looks like. First, you have your operating activities. Net income is where you get a lot of your cash. But then we make all these little adjustments, and notice then we go through changes in inventory, accounts receivable, accounts payable, and unearned. those are your working capital account. We adjust for our net income for all those changes. The $17 billion here is the cash that Amazon got from operating activities. So that's good. So just from their normal operations, that's where the cash came from. So then I go to investing activities. So they reduced cash from their investing activities. That's actually a good thing. That means they bought more buildings, they're growing. We want to see a plus up here, but minus here isn't necessarily bad. And then lastly, they put the financing, paid some things off. If you repay something, it reduces your cash. If you issue some debt, you get some cash. So the end is the change in the cash for what would that be, $1 billion. So that's what Amazon's statement of cash flow looks like.